Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 269 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Morning, Mark. How you doing?
Good to be back on the podcast after taking a little bit of a break. A lot going on the past 2 weeks, and especially this week. Had the first presidential debate between Trump and Harris. We had inflation report on Wednesday, expected Fed rate hike next week.
Jobs report last Friday.
Election in just about 2 months. So there's a lot going on and a lot of headlines.
A lot of cross currents.
A lot of cross currents. So as always, before we get into our discussion, we'll quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y-Charts, and as of the market close on September 11th of this week. S&P 500 index down 1.7% for the month and up 16% for the year. The Dow Jones Industrial Average down 1.7% for the month as well, up 8.4% for the year. The Nasdaq Composite Index down 1.8% for the month and up 15.9% for the year. The Russell 2000 Small Cap Index down 5.1% for the month and up 4.1% for the year. And the Vanguard All World ex-United States ETF down 2.4% for the month and up 7.2% for the year. 3-month Treasury rate at 5.1%, the 2-year Treasury rate at 3.62%, and the 10-year Treasury rate at 3.65%. So we've really seen yields come in as the expectations for rate cuts over the next 6 to 12 months have increased, obviously.
Just want to throw it out there. My opinion is the longer end of the curve. And so for our newer listeners, that's such as the 10-year Treasury rate. It's come in so much, I would argue it's priced in, say, over the next 4 to 5 months, a lot of those price cuts that are probably going to happen in interest rates.
Right.
So I just want to throw it out there that if you start to see a cut next week and a cut 6 weeks thereafter, but maybe you don't see the 10-year move much from where it's at, that's because it's priced in.
Right.
So I just want to throw it out there that the market is being anticipating, per se, of this cut coming up.
Yeah, and finally starting to see some strength in bonds that we haven't seen for a long time, right? Yeah. Because of that inverse relationship with yields and bond prices.
Yep.
Moving on to big headlines and current events from the week. Like you mentioned earlier, Matt, the August jobs report that was released on September 6th. U.S. non-farm payrolls increased 142,000 in August, which was below expectations. And additionally, the prior 2 months were revised down a net negative 86,000 jobs. So with July now sitting at 89,000 jobs, it was 114,000 when it was reported. And 118,000 now for June jobs report. It was 179,000 when reported. So it is normal for this stuff to get revised because the initial data is not right most of the time. Not super shocking, but the job market does seem to be softening a little bit. But the jobless rate did tick down to 4.2% as expected. It was, I believe, 4.3% prior to that.
Okay. Yep.
Anything else you want to add there?
No, I guess the only comment I'd love to make is keep a close eye on full-time job numbers. This is a combination of part-time and full. And I really want to see how those numbers react in the first half of next year. I think you've seen some softness in full-time jobs. Doesn't surprise me. Uncertainty, presidential election year. We'll see how those numbers look in the first half of next year.
Right. Moving on to tweets, articles, and research from the week. First thing I had was just a chart of the S&P 500 over the past month, just showing how it has been a rough start to the month of September. So Jenna will throw this little mini chart up on the YouTube page for people. Chart of the S&P 500 from August until about September 9th. And just wanted to show that the first 4 trading days of September was the weakest 1 week performance since the regional banking crisis in 2022, or excuse me, March of 2023 for the S&P. So the S&P fell 4.3% in just a 4-day period to start, right?
Yeah.
It also was the worst week for the Nasdaq since 2022. And also, not to pile on, it was the worst 1-day start to September since 2015 and the 5th worst start to September of all time. So, as we've kind of been talking about earlier in the year, we had not predicted, because I don't like that word, but we're planning on weakness in the market a couple months leading into the election, and that September weakness seems to be, at least for right now, playing out.
Yep.
Typically, more of the weakness is loaded in the back half of the month, but obviously the first week was not kind to markets. It's been a little bit of a rebound trade this week so far, so we'll have to wait and see. But also, as we mentioned before, next week we have the Fed with their announcement, widely expected to cut by 25 basis points.
Yep.
Some are trying to push them to cut 50 basis points or 0.5%. So September tends to be a pretty volatile month, and I think that we should continue to expect that over the next couple of weeks.
Par for the course. Even I would argue, to bring it even further, the first half of October tends to be similar. So if you see these gyrations in the market rallies significantly to the upside or sells off significantly, relative to the volatility we had in the first half of the year, that's just normal for the 4th year of the presidential election cycle this time of year. Doesn't necessarily mean that the underlying fundamentals of the market are bad. You're going to hear me talk about some thoughts on if a recession is close or not here in a little bit. I don't think it is, but the market's going to act at times like that's happening.
Yeah, and it's kind of interesting. 2024 is kind of playing out eerily similar to 2023, where markets were pretty strong in the first half of the year, the first 7-8 months of the year. Yep. And then you had this big pullback from July until October last year.
Yep.
And kind of similar, it was started in August this year or late July, but have had a pullback. And I guess we'll wait and see if that pullback's going to continue like it did in 2023. But the important point to remember there is that the market bottomed late October. I think it was one of the last couple days of October last year, and then had a really, really strong finish to the year.
You had 8 straight weeks of a rally in November and December of last year. So, just to remember, you see this price action is not necessarily indicative of underlying fundamentals. And what really started to turn that around last year is you had earnings season. And so what happened was you had companies coming out at the end of October, beginning of November. They were reporting earnings for Q3, given their outlook for Q4. Things were good. Money piled right back into the market. And so, the market definitely has a habit of shooting first and asking questions later. This is another kind reminder to invest for your time horizon, right? We're going to have a lot of choppiness between now and let's just generalize middle of October, par for the course, invest for your time horizon. Just know that short term, I think the headlines are going to continue to be unnerving. But this is something that for our regular listeners on the podcast, we've been talking about, I think, for several months, getting them ready for.
Mm-hmm. Yeah, and the second thing I had kind of relates to the first point that I made. This was a Chinese proverb that I had found.
What do you got?
I can't remember where I read it. So the proverb was, fish see the bait but not the hook, and people see the profit but not the peril.
Ooh.
So, kind of relating this quote to the markets, I think everyone always sees the returns in the past, for example, on a yearly basis, right? That's how, investment managers and the market is judged as what's been the return for 2023 or 2024. On the outset, it looks like it's pretty easy to achieve, right? But what most people don't see is the volatility and drawdowns that come with those yearly returns, right? unless you went to sleep on January 1st and didn't wake up until December 31st, and the market averages between 7 and 9% per year, one would think, oh, it's
easy.
It's pretty easy, right? But the peril referred to in this quote is obviously the necessary evil that we as investors have to deal with on a month-to-month and year-to-year basis. And I think it's especially timely to share this now with the super weak start to September and potentially the weak couple of months ahead of us before the election in November. One of the things that I was talking to clients about earlier this week was, if you look at stock market performance after 12 months after the first Fed rate cut, it usually tends to be pretty good. But people look at that and they don't see what it takes to get there, right? And I think the average drawdown from the peak to the trough throughout that 12-month period was close to 14-15%, right? So even though returns tend to be good 1 year going forward, it's not going to be without some sort of mid to large pullback, right? And I think that we just need to be prepared for that.
Absolutely. I mean, the most recent example is someone could look at the S&P 500 returns year to date and say, oh, mid double digits, easy peasy. But then you had to endure from mid-July to the first part of August, literally almost a 12% correction from high water mark to the bottom. And the problem is the most investors, especially ones who are older and retired, aren't comfortable having that heavy of stock exposure, subjecting themselves to that type of volatility. And so I just want to take it one step further. I think you are providing a good example that, hey, historically and statistically, when the Fed starts to cut, that's not necessarily spells doom and gloom for the market. However, there will be volatility because of the Fed starting to cut rates. Statistically speaking, look at history. You'll have a double-digit drawdown at some point that first year. That's par for the course. So when that happens, you need to trust that process and know that is a part of it. No one can tell you when that double-digit correction will occur. But statistically, it will. And again, the market tends to shoot first, ask questions later. That's why you have these sell-offs and these comeback rallies. And I'm just still in the camp that the market's going to continue to kind of stair-step higher. And corrections are going to be, we're back to normal on those. And for the most part, they'll be relatively V-shape, but they're not fun to go through.
Right. Last thing I had was had a lot of self-created content this week. I didn't really take it. So yeah, going in a different direction than I usually do. But this is a chart that I've created on stockcharts.com. It shows the S&P 500 along with the yield curve. So the yield curve that I'm referring to is the 10-year U.S. Treasury bond, the interest rate it's paying minus the 2-year Treasury bond interest rate, right?
Yep.
Jenna will throw this up on the YouTube video, and this will be in our show notes. But just to recap, the yield curve over the past week or two, Matt, has normalized or uninverted. And, just to go a little bit deeper for newer listeners, the yield curve refers to the 10-year U.S. Treasury rate minus the 2-year U.S. Treasury rate, right? And normally, in a normal environment, the 10-year pays a higher interest rate to holders because a lot more can go wrong in a period of 10 years than 2 years. And we define
you're locked
that as
in on that rate.
Right. It's being defined as more risky, right? A more risky investment. But there are times like the past year and a half, 2 years, where shorter term bonds actually pay a higher interest rate than longer term bonds. And when that happens, we refer to the yield curve, yield being the interest being paid out, as being inverted. And as you can see in the chart, each time that green line, the yield curve, has gone below the zero level, which we define as an inversion, and then pops back above the zero line, the past 3 times it has not been kind to stocks. I want to point out that especially 2 of these instances was in 2001 after the dot-com boom and bust.
And 9/11.
And 9/11. And then also obviously the great financial crisis in 07 and 08. Briefly, the yield curve inverted in 2020 or end of 2019. And then obviously we had COVID. The important thing I want to point out here is that there have been times, especially in the 80s, there were several yield curve inversions, and stocks just did just fine over the next year or so. So I don't want to be a prisoner of recency bias, right? But just throwing it out there, the past 3 times that this has happened, stocks have gotten hurt pretty bad, right? Big sell-offs. We're talking, more than 30%.
Sure.
So just something to throw out there to play devil's advocate, because I know most of the time we do provide bullish research, but I think that's for a reason, because markets are up every 3 out of 4 years. So I think that's what we should be doing.
Sure.
But from time to time when we see things like this, just pointing out that, hey, could be in some more higher than normal volatility over a longer period of time, not necessarily tomorrow or the next month, but this could come within the next 12 to 18 months.
Yeah, I think that's well said.
Sense.
And I think it's good to kind of throw that out there. Plus, in addition, this is something our listeners and viewers could read about, and they need to, I think, have some context behind it. And kind of where I stand on this ultimately is, there were some extenuating circumstances in 01 and 07 and 08 that I think muddies the waters a little bit for the data set. I think it's still important to know that they're a part of it, and that statistically you want to get a little hypersensitive once these things also uninvert. Once the Fed starts to lower rates, I think you need to get a little more sensitive to the economic data. That's kind of how do you make this actionable? That's how I would respond.
Yeah, and I think the last couple of times it was it was crisis mode, right? Obviously, COVID, crisis mode. Obviously, great financial crisis, crisis mode. 9/11, crisis mode. So I'm hoping there's not a crisis on the horizon that we don't know about yet.
Correct. It could be. Yeah.
There could be in the future, but as of right now, nothing so far. So we'll knock on wood, and hopefully it stays that way. But there are a lot of eyeballs on this right now. It's recently over the past year, it's one of the widest followed indicators. And again, as we've talked about before on the show, and typically a lot of people are on one side of the coin, might surprise people on the other side. So
it goes back to your old adage. It's the things that the market's not focused on that tend to derail it, not the things everyone's focused on.
Yeah, and it's just, it's like people look back and say, hey, every time X has happened, the markets have done Y until 6th, 7th, 8th, 15th, 50th time where the market does the opposite, right? And that's the thing about markets that makes it difficult is there's no secret code or secret sauce to make sure that you're nailing the bottom and nailing the top every single time, right?
That's right.
And that's why it makes it so difficult.
That's why you can have a long-term time horizon.
Correct.
We use our podcast hosting site that's called Blueberry. That's spelled BLUBRRY. If you want to create your own podcast, you can go to their website, use the promo code JessupWealth to get your first month of Blueberry podcast hosting for free. You can go on there, choose your ideal plan, use their hosting estimator on their website. Again, you can receive your first month free with the promo code JessupWealth, all lower cases. And in addition, if you're looking for a good piece of AI software to help you note take and summarize a meeting, we highly recommend Firefly's AI software. You can use the link in our show notes below to purchase your subscription and make life a little bit easier. My first piece is an interesting kind of opinion on the market right now. And the reason I selected this, it's a piece from Torsten. He's the chief economist at Apollo, which is a private equity firm. The reason I selected this is back in Q1 of this year, I was at a conference where Apollo spoke, and they gave their economic outlook for 2024. What stood out at me in that presentation and that talk was that they were one of the very few people on Wall Street at the time that was expecting either 0 or just 1, 2, or 3 rate cuts this year. If we go back to Q1, most economists in Wall Street were expecting 5, 6, 7, upwards of 8 1/4 point interest rate cuts this year. And how many have we had up until this point?
0.
Now, there's expectation that's going to start switching coming up here. The Fed meets every 6 weeks with the next announcement next Wednesday. But I want to kind of throw out there, you fast forward to September 7th, this is what this same economist at Apollo is seeing. I'm not taking this as scripture, quote unquote. I think it's just an opinion that I find interesting, okay? And I got this by a post by Mike Siccardi on September 7th. Again, Apollo. Here we go. The title of the note is, "This is a Soft Landing." Ready for this, Mark?
And I think just to point out, when people are talking about a soft landing, they're talking about the Fed, number one, not wrecking the economy and managing lower inflation while also successfully managing rising unemployment is what people are referring to.
Yeah, normalizing interest rates after the kind of the hyperinflation, right? Mm-hmm. Without wrecking the jobs market or the economy doing so. So this is what Torsten wrote. He goes, looking at the incoming data, the facts are the following. 1, the unemployment rate declined in August. Looking at the establishment survey and the household survey, it's difficult to see strong signs of a slowdown in job creation. 2, wage growth accelerated to 3.8% in August, and wage growth remains sticky well above pre-pandemic levels. 3, daily data for debit card transactions show that consumer spending has been accelerating in recent weeks, driven by spending on clothing, food services, drinking places, sporting goods, motor vehicles, parts dealers. 4, weekly data for retail sales went up last week and remain solid. 5, jobless claims have declined for several weeks. 6, continuing claims have declined for several weeks. 7, default rates and weekly bankruptcy filings are trending down. 8, the Fed's weekly GDP model suggests GDP is 2.4%, and the Atlanta Fed GDP now says GDP this quarter will be 2.1. Remember, what's the technical definition of a recession, Mark?
Two consecutive quarters of negative GDP growth.
That's right. I'll let you speak for yourself. I'm old school. There's no funny business with it. 2 consecutive quarters negative GDP growth. That's a recession. Mm-hmm. We technically had that in the first half of 2022, as a reminder. 9, weekly data for S&P 500 forward profit margin shows the profit margins are near all-time high levels. 10, the stock price of staffing firms is rebounding, which suggests that we could have a rebound in job openings. Torsten says the bottom line is that the U.S. economy is not in a recession, and there are no signs of a recession on the horizon. Again, his opinion, his thoughts. I just want to throw it out there that will a recession come again? Absolutely. It's just a matter of how near it is in the future. And again, looking at that definition of a recession of 2 consecutive quarters of negative GDP growth, I'm not seeing it so far here in Q3. Doesn't mean it can't manifest itself beginning in Q4. As you were kind of playing devil's advocate earlier, I'll do that. But based upon the data I'm seeing right now, I don't think that should be an immediate concern, okay? So to build upon this narrative, I saw this piece from Bespoke Investment Group, and what they had posted, and this was just last week, they had a piece about if a recession looms, high-yield bonds don't see it. And what they did is they showed a chart, and what it shows is the excess yield that someone is receiving by investing in general in high-yield bonds, junk bonds, versus the risk-free rate, okay? And I know you're a little bit more versed on this topic. Will you generally kind of educate our listeners for a minute or two why people tend to watch this and why it could be significant indicator about people's worries or anxieties about where we stand in the economic cycle?
Yeah. So if you're not a, speaking as if I was a company, like a publicly traded company, if you're not the U.S. government, if you're not Apple, if you're not Berkshire, if you're not Visa, and you are a smaller company, when you offer debt, you need to pay your debt holders a higher interest rate than the U.S. government or an Apple because, number one, you don't have access to the same capital as them, and number two, your business is riskier, right? Mm-hmm. And typically when high yield rates are higher, that means companies need to pay a higher interest rate to entice people to hold their debt.
To take on that additional risk.
So the theory here is that if companies are offering debt at super high yields relative to investment grade bonds or U.S. Treasury bonds, that means, hey, investors are like, you have to pay me X amount of interest for me to even be interested in buying your debt because your company is way more risky than the U.S. government or than Apple or than Visa. So typically when you have a lot of companies raising the interest rates that they're paying to debt holders, it's like, maybe those companies aren't as strong as they make it out to be.
And maybe the broader economy is not as strong as people think.
Correct. So it's a simple, if there's more risk, there has to be more reward, right?
And I would argue, bond investors are generally some pretty smart investors, especially on the corporate side. And they're really good, I feel, for the most part, assessing risk. And what the bond market, specifically the high yield bond market, is telling me is they're not as concerned about getting their money back.
Right. And just to make it even simpler, think about it this way. If there is I'm just making up hypothetical numbers. If there's a 50% chance that I'm going to lose my money, then I need an interest rate that's, let's just say 15%, right?
To compensate me for that.
Rather than investing in a U.S. Treasury bond where, at least so far in the past, there has been a 0% chance that I would have lost my money, then I can take 4 or 5%, right?
Yeah.
So I think that's probably the best way to think about it. There's just a higher likelihood that that company is going to go bankrupt. They're not going to be able to repay their debt, et cetera, et cetera.
So I just want to share that with listeners and viewers. First of all, great explanation, Mark. I appreciate that for our listeners and viewers. It's just one of those tells, right? What's the health of the American economy right now? What's the threat of a recession in the near term? And I think looking at the additional yield people are demanding in the high yield market compared to the risk-free rate is one of those important indicators. I would be in my top 15, one of them I would look at.
Yeah, a lot of the high yield stuff that at least we look at and that I look at on a weekly basis, it's, between 6 and 7%, and the 3-month U.S. Treasury is paying 5%. So
look at that.
That's really not that big of a difference, right?
2 more pieces. This will go relatively quickly now. My third piece is lots of investors with long-term time horizons, Mark. They're crying for a correction in the first half of 2024. There's a piece I'll have Jenna put up for our YouTube viewers. This will be in our show notes. This is from an ex-post from Brew Markets on September 6th. And along the lines of where you started out the podcast with, it said, quote, the U.S. stock market has now erased $2 trillion in value this month. It's only been 4 trading days. And it shows the quote unquote heat map of the market. And it shows some of the size of the illustrations is relative to the company's market capitalization. And you're just seeing some of those huge moves to begin the month. This is not a recommendation for or against any of these names, Mark, as our regular viewers hear me say often. But I'm just going to throw out some of these crazy numbers. It showed Apple down 4, Microsoft down 3 and change, NVIDIA down 14 and change, Alphabet down 6 and change, Eli Lilly down almost 5, Broadcom down over 13, JP Morgan down 4, etc. And so the reason I just want to throw this out there is if you're under allocated to risk, the times where it tends to feel uncomfortable to make those investment decisions, in hindsight, tend to work out quite well if you have the right time horizon. That's as much as I'm going to say. Everyone wanted their turn at bat. Mm-hmm. You're getting some good pitches if you have the right time horizon.
Correct.
So the next thing I have, yesterday was interesting. You and I were talking about it just very briefly before the podcast began, about 30 minutes ago. If you look, Jenna will put up this image for our YouTube viewers. This will be in our show notes. This was in my feed last night. And you're going to see 3 regular contributors to our podcast that we discuss content from. You see Ryan Dietrich, you see Callie Cox, you see Bespoke. And there's a commonality. They're all talking about one thing that happened yesterday. Mark, you want to share it with listeners and viewers?
Yeah, so there was a big intraday reversal, what we call it in our industry. So stocks at one point during the day, most of the indices were down negative over 1%. And a lot of the major indices actually finished up over 1%. So there was greater than a 2% move from the lows to where stocks closed for the day. And typically, as Ryan points out and others, this tends to be pretty bullish going forward. And it's tended to mark previous market bottoms. I'm not saying it is going to this year, but typically in bull markets, we would rather see stocks open up weak and close strong. And typically in bear markets, you see stocks open up strong and close weak. So as of right now, we're still in a pretty severe uptrend, in my opinion.
Since the lows in 2022 in October of 22.
Correct.
Yep. I just want to throw it out there. You might see this on the news. It's hot off the press. This is why I encourage listeners to listen to these podcasts relatively after they are released and produced by the firm, by Jenna. But the last stat I'll throw out there is the 12-month forward-looking return when this type of action tends to happen, going back to the 70s, based upon data from Ryan Dietrich yesterday, is on average about 12% higher. And with a success rate over the next 12 months of the market being just higher in general of 72.7% back to the 70s.
Right. And as a reminder, that's 12 months from now. That's not a month from now. It's
Correct,
not 3
sir.
months from now.
Correct. And you're going to have some corrections.
Correct.
Have some corrections over that time period.
Moving on to the financial planning topic of the week. This was from a newsletter from Taylor Schulte at Define Financial, talking about what a power of attorney is and why you need it. So again, just a important reminder for everybody. We talked about it before, but for newer listeners, a power of attorney is a legal document that grants a person referred to as the agent the authority to act on behalf of another person who's referred to as the principal. The extent of this authority is explicitly outlined in the document you create. It can range from very broad, sweeping powers to a limited authority for specific circumstances. So it's very customizable based on your situation. So there's two different types primarily of POAs, an immediate POA and a springing POA. Immediate POA, obviously, just like it sounds, goes into effect when the document is signed.
Yep.
The springing POA only becomes effective if the principal loses capacity and is less favored because proving incapacitation can be challenging. So let me pause there really quick. Can you just tell listeners 30 seconds what you have to do usually to prove that someone is incapacitated and can't make financial decisions or healthcare decisions for themselves anymore?
Yeah, generally you're going to need a doctor to sign off on that. Upwards of 2 doctors to independently say, hey, this individual is unable to make financial decisions or, in essence, make decisions any further beyond that point. Usually you'll have upwards of 2 doctors who will make that assessment.
Thank you. Number 2, what are the responsibilities of a POA? He says naming someone as a POA means that they have the legal authority to act on your behalf. This role is often utilized when you become ill, disabled, or are otherwise unable to manage your affairs. Without a POA, a court may be left to decide what happens to your assets if you are found to be mentally incompetent, and the court's decision may not align with your intentions. Here are some common responsibilities a POA may be expected to undertake. Oversee and manage your financial affairs. Have direct access to and manage your bank accounts. Make decisions regarding your insurance policies, maintaining possession and manage your estate documents, file your tax returns, access and manage items in your safe deposit box, sign documents related to the sale or purchase of your real estate, and then detailed record keeping. What a POA cannot do, write, amend, or revoke estate plans. In most states, a POA cannot write, amend, or revoke a will, trust, or other estate planning documents of yours. They cannot vote on your behalf. They cannot make decisions that are not explicitly stated in the POA document. They cannot transfer your assets into their own name unless explicitly authorized, and they cannot borrow or lend money on your behalf unless the POA document specifically grants this authority. So I think the concern for a lot of people, if they're not familiar with POAs, is it's like, hey, I don't want to turn powers over to somebody that they can take all my money or, do things that aren't in my best interest. again, you're not just naming a random person. This is usually a loved one, a spouse, a family member, a close friend. That I think the most important thing in this case is that you don't want the courts that know nothing about you and nothing about your desires to decide what happens to all of your assets if you can't make those decisions anymore.
Well said. And I want to give a very much boots on the ground example of the importance of these POAs. I have a longtime client, over 20 years, that has been with me. And this client specifically had a POA on file. And a very unfortunate thing happened about a decade ago. One of the spouses had a stroke. And after that stroke, she became incapacitated, mentally unable to make her financial decisions. If this durable power of attorney, also known as a financial power of attorney, was not in force prior to her incapacitation, then the only choice the other spouse would have had to manage her finances would be to go to the courts and get a guardianship. This is one of the most understood topics because you hear examples, Mark, where someone gets in a car accident and the spouse is able to go to the hospital without a technical healthcare power of attorney and make healthcare decisions on their significant other. On the finance side, your spouse cannot call XYZ bank, XYZ custodian, Social Security, go down the list, and then sit there and say, I'll use me and Rachel as an example. I can't call on behalf of Rachel to XYZ bank and say, hey, my wife has an account. I need to pay some of our bills. She's incapacitated. I need to get some money out of that account. They're going to say one of two things. Show me a POA that's been forced prior to her incapacitation, or go to the courts and get a guardianship. Mm-hmm. There's no way around it. And so the importance of having these documents in place, even if you use the springing POA example that you mentioned at the beginning of the financial planning topic, these documents are important to have. You can either seek out an attorney that's licensed in your state to help you with these docs. There's a lot of self-guided legal sites out there, Mark, that are very popular. I want you to kind of equivalate like a TurboTax, but for legal documents. Step-by-step questions. There's ways to get these things efficiently.
Yeah, and I didn't even think about this, but this is another thing that I'm sure AI is helping with or going to help with in the future. Is you can probably go on a website and say, hey, these are the powers that I want my spouse to have if I become incapacitated. Put it into the system, and it just spits out a whole POA for you that has all of those powers listed, right?
Sure.
So it's really, these things aren't hard. They just take just a little bit of time and a little bit of planning to work with obviously a licensed attorney, but something that is very, very important that we highly recommend that everybody has.
Yeah. Final comment again is Mark and I, we are not lawyers. We do not have our law degrees. So I just want to throw it out there that this is education on the power of attorney side. And obviously, as Mark said, seek out a licensed attorney in your state for specific legal advice to your situation.
Yep. Anything else before we leave it there for the week?
Big talk of the town next Wednesday, 2:00 Eastern time, Federal Reserve announcement. Personally, I'd be shocked if it's more than 25 basis points.
Yeah, I think the fear there is that if they cut by 0.5%, people are going to be like,
what do they know that we don't?
What do they know that we don't know?
Yeah.
Which I think would not be beneficial to stocks in general, but we'll have to wait and see.
Yeah, I think they do 25 and forecast another 25 at the next meeting.
Yeah, the Fed futures rates and probabilities that we look at on the CME, the Chicago Mercantile Exchange, are usually pretty accurate, and I think there's over a 70% chance.
I did not look at the stats recently. Okay,
maybe even as high as 80.
Okay,
a 25 bip cut. But actually, while we're speaking on this, I'll just pull it up right now. As of today, which is just under a week from the Fed announcement. Yes, I will accept all cookies.
Listeners and viewers, Mr. McEvely is plugged into the data.
I am.
He has it at his fingertips.
Oh, yeah, here we go. There is a 87% chance that it's 0.25%.
There you go.
Rate cut.
There you go.
13% chance that it's a 0.5%. So usually this stuff is pretty accurate.
Because there's big money behind it.
Because there is big money
behind that stuff.
We can
talk about it a different time.
We can. Obviously, Fed next week. It's going to be the end of the third quarter here before we know it. We're going to be thrown right back into earnings season in October, really.
I'm a kid in the candy store in earnings season. I enjoy it.
It seems like it comes and goes and there's not a lot of time in between. But so we'll be giving updates on earnings season for the big mega cap names when those come in. But other than that, we will be back with you for next week, episode 270, the day after the Fed announcement.
Can't wait. Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.